Hello, I am Sensei Kevlar. Thank you so much for joining me. I want to start off our Mindset Monday with a reminder that this is not trading advice or financial advice. I'm not a financial advisor. What I'm trying to do is offer you a mindset with regards to how to make money in these markets by trading. And part of that mindset comes with a couple of realizations about how the markets actually operate. So I've shown you how the markets work and how they go up and down and how you can dollar cost average your way in and how you can plan. Let's take a look at the long-term picture for just 1 second. It's one of my favorite sites. It's called Compound Daily. And what it allows you to do is it allows you to calculate your daily interest. If you were to take a fixed amount and then compound that over a daily interest rate for 365 days, and you're reinvesting all of it, and we're not even going to include weekends. We're just going to go ahead and exclude weekends. Let's take a look at what actually happens. So what we're doing is we're projecting the scenario now where we're trading in the crypto markets and we're making 1% on our money daily. And how we're doing that is we're working our way into different markets and making small gains, 2%, 3%, 5%, 10% gains on small amounts. And those are adding up to 2% daily over the course of the weeks and weeks that we're doing this, right? Well, what we can quickly see is that in the first month, we will have basically doubled our money. Here's the first month. By the end of 90 days, we will be at $30,000, having started with 5. By the end of 150 days, we're close to $100,000. By the end of 190 days, we're at $200,000. By the end of day 230, we're rounding on $500,000. That puts us on $1 million before the year is out. The slow, steady gain principle does work. Compounding your money is part of the mindset. So if this is the goal, if this is what we're trying to achieve, if this is the compounding effect that we're looking for, what we need to do is we need to do 2 things. Number 1, we need to size our portfolio appropriately for each of our opportunities. And much more importantly, number 2, we need to be creating opportunities for ourselves that actually are paying out over this magic number right here. So how in the hell do we do that? Well, the answer is simple when you look at the actual charts. Because realistically, you can't know when any one opportunity is going to take off. You don't know when this is going to just go banana weed and through the roof. On the other hand, you don't know when something's going to do exactly the opposite. Or it's going to, sink on down and then bust through the roof and give you a good 20%er on a small amount, on a small investment. If we cannot know what the opportunity is and when it will occur, if we only know that the markets are going to make us these opportunities, then clearly part of the strategy must be diversification. It has to be without saying. It has to be so clear in your mind that if we could know which opportunity was going to just bust out when, we would just invest in that one. If we could know when the market was going to only go up next, we wouldn't need planning. Diversification is a function of the strategy and the unknowability of when some opportunity is going to go up. You need to not just have a plan for one market, but have a plan for all the markets that you're planning on trading. If at the bottom of an opportunity, where you project an opportunity to have a bottom down here at 0, you want to be 10% allocated, and that's your plan, and you're back here, and you're making that plan, and you know you're going to be 10% allocated at the bottom. Well, that means that you can do that for 9 more opportunities. Planning tells you what your diversification factor can be. If you plan for 1% of your portfolio at the bottom of the opportunity, there's 99 more opportunities that you can take advantage of. You want to know what opportunities to take advantage of? Go look here, the coin market cap. Okay, you've got the top 10 and they're always changing. Okay, these are opportunities, all of them. You just have to be in them to make the money. And look at this, they all do the same thing. They'll give you the sweet little bump if you're paying attention. If you have bought here, you can sell here and make your money. Because this is a good, 13%, right? If you have bought here, you can do it here. If you have bought down here, when it goes back up, you can do it again. If you bought here, you can dollar cost average here. If you bought here, okay, on the same time frame that this thing is making you dollar cost average, this one is making you money. This one is making you money. This one's making you money. This one's making you money, right? This one's you're having the dollar cost average. This one's making you money right here. When you dollar cost average here, you could be sold right here. This one's making you money across the board. This has to be part of the strategy. If you're sitting here saying, well, I'm not making any money because the thing that I'm buying is just going away and away and away from me, well, buy something else. Make a plan for something else. In fact, that should have been part of the plan to begin with. That should have been part of the allocation for where you take your money where you make your money at the bottom of the market. And then when a new opportunity arises, plan to have an allocation ready. Plan to have something left over. Plan to get into a new market. Plan to take advantage of a dip. If you plan correctly, these markets will make you money even when other markets are going away from you. If you're doing this over time and you're making 10, 15, 20, 30% here and there on small amounts, that can add up to large amounts, like 2% of your portfolio. If we're even just, if we're just buying this, a small amount here and we're just making some small change on it, we're making $5 or whatever on it. Automating that and automating the opportunity that comes after it when it does do this, because it can and it will at some point. It's not going to do this forever. It's only going to do this as long as it does this, and it can still do this more. It can still come down here. Diversification. So diversification is part of the nature of the way that creates more work for you. Your work is never done. If you're not making money, diversification says, well, go make your money somewhere else. Should have bought this one instead. Should have had an allocation ready. How many did you plan on? How many did you automate? How many are you tracking? How many are you capable of? It comes down to your tools. Okay. Now, if diversification is the force that keeps us creating more work for ourselves, and I don't even, I don't even think you should be stopping at just buying these, right? There's a whole other markets of opportunity. There's, for instance, ICOs. There's mining contracts. There's all kinds of opportunities to make money with your money. Now, I'm not saying that any one of those is a good idea. ICOs have been famously exit scammed. Mining contracts has been recently famously not making money. But if you're creating an opportunity for yourself and you're doing your accounting in such a way that you're creating these opportunities at zero cost for yourself, what you could do is you could simply remove those from the exchange, stick them in a cold wallet, and then it doesn't matter. That's a form of diversification. Betting on the future when this thing, you come back to it a year and a half later and it's mooned or it's tripled in price. Storing things on a cold wallet, buying physical goods that are resellable on the open market. It's another form of diversification. Keeping money in your bank account, a form of diversification. All of this is critical. And if diversification is the thing that tells us that we always got more work to do, because we always do, there's always another market to go plot. There's always another plan to make. There's always another, improvement or opportunity or signal in that we can, apply. Then there must be a force that keeps us sane, because this would turn into a nightmare very quickly as you realize what the extent of the work required in making all those plans and keeping all of those dollar cost average, keeping all of those spreadsheets updated, keeping all of those plans. If diversification is the force that makes us do more work, then automation is the force that removes the work from our hands. So the nature of the diversification is to always be multiplying, always be increasing, always be creating more. It goes 0, 1, 2, 3, 4, 5, 6, 7, and it never stops. It just keeps counting. The nature of automation is 0, 1, 2, n. Let me write that down. If this is, let me pull up the notepad. If this is diversification, and on and on and on, then this is automation. In diversification, we're always multiplying, we're always creating more, we're always turning 1 into 2 and 2 into 4. The idea behind automation is to recognize a pattern and automate that pattern. Obviously, if you don't have any data points, then we don't have anything to automate. But the first time you do something, it becomes a data point. The second time you do something, it becomes a trend. If you plot 2 data points, you have a direction, a vector. If you have more than 2 data points, what you have now is a pattern. And if you have a pattern, you can automate for that pattern and deal with that pattern in a singular way. It's to always come back to one. So if you have 4 exchanges that you're working across, then what you want to do is you want to create one view. To look at your whole portfolio. If you have 4 opportunities that you're invested in your portfolio, what you want to do is you want to create one view to see all of them at the same time in relationship to each other. If you have 10 strategies that you're all running, you want to create one workflow to manage them all. At most, you might deal in things in terms of 2. You might deal in groups in which you say, Group A and Group B. And then you can treat them, Group A is a singular thing and Group B is a singular thing. But as soon as you have more than that, you recognize a pattern and bring it back to one per the nature of automation. Now, all of this is good and fine as it relates to mindset. But what I want to show you is how this relates to trading itself. And with regards to actually placing the trades. In the past, what we've done is we've figured out that what we want to do is we want to come in here and create our opportunity, create our plan, create our opportunity for ourselves in terms of a plan for buying in a market that's going down more and more and more in order to create a larger and larger opportunity for us. And we're getting the signals. Here's our signals that we've been waiting for, telling us it's time. Right? If you bought in here, you needed a dollar cost average here. We're definitely seeing a very noticeable trend right across here. You take this and touch this peak and extend it up to here. We're getting a really beautiful trend right coming across here. Okay, so we're seeing volume increase. We're seeing allocation increase. We're seeing people prepare for the next bull run. When we did this, what we wanted to do was we wanted to automate that solution that we prepared for ourselves. The one that had us buying here, doubling up here, tripling up here, whatever it is that we did. More to the point, while we're at it, we also want to automate ourselves. The initial profit taking right here, followed by the long shot here, followed by the whoopee right here, all the way up to here where we finally get rid of everything that we sold in preparation for buying it when it comes back down. The whole point is that coming in here and actually setting these trades is tedious, but what we found is they found our first set of automation. The very first set of automation, and the one you should, be thinking about first and foremost, is going on to the exchange and entering the trades as limit orders. Nothing's stopping you. If you know where you're going to be doing the buying, go ahead and do the buying. If you know where you're going to be doing the selling, because you already did the buying, go ahead and do the selling. That's automation. But of course, you want to make things a little bit smarter than that. And so the first thing I want to introduce you today is the stop loss. And the stop loss is a tool that traders use in order to automate their trading. And normally when people talk about stop loss, they're talking about applying it in terms of losing trade. I'm not using it that way. What I'm saying is we came down here. Okay. Let's assume for just 1 minute that, it bounces around and does one of these, comes back down, bounces back up, doesn't really give us anything, doesn't really give us an opportunity, right? Does one of these, kind of screws around through February, and then in March, we do one of these. April, May, June, July, where historically all of the action has taken place. Okay, something like that. Let's pretend for a minute this is really what the market gives us, right? We know we're going to sell here and buy here and sell here and do all those nice things, right? What we want to do is we want to maximize our opportunities, though. If this market is going to continue to sink away from us, well, we can probably avoid buying. So when we're automating, what we can do is we can say, what I want to do is I want to set up a window between here and here. Okay. Now, if it goes up, I want to go ahead and execute the buy order. Because look, it's going up and I want to be in for the opportunity. But if it goes down and it touches this line right here, what I'm going to do is I'm going to move this line down, right? Remember, the chart's coming down. So it comes down and it intersects this line right here. What I'm going to do is I'm going to move this line down where I'm executing my buy order. And then I'm going to move this line down as well. And I'm going to wait to see what happens next. Okay? So now the chart comes down to here and it kind of goes sideways for a minute. And then it comes down to here and it touches this line. What I'm going to do is I'm going to move where I'm making my buy order down to here. And I'm going to move this down again. It comes down again, touches this buy order. This gets moved down. This gets moved down. This happens one more time when we come down here and touch this thing right here. Okay. Finally, the market does a real turnaround. Comes up here and touches this for the first time. And I execute my buy order. Well, look at the difference. I could have bought here because my signals told me to. And in the worst case scenario, I would have bought slightly higher. Yes, that's true. Would have bought around 120, 25, 123. Because I would have seen the market going up. But in the much better case scenario, where the market continued to sink away and give me a better opportunity to buy, that kept me out of the market. All the way down to here, where the market finally turned around and gave me my buy opportunity. Okay, so what we did now is we combined automation with planning in order to give us a better opportunity, a better chance. Because this is just dumb luck that the market did this for us and gave us this better opportunity. This is automation having created that opportunity out of that dumb luck. This type of automation is critical because you're not always going to be here. You're always going to get this right. This is not always going to be the bottom. And this can help optimize a plan that would otherwise have you buying right here. And you can see it's still a possibility. It's still something that might happen. It's still something that might happen, and you know what else could happen? Is this could happen. Not saying it won't. Well, it won't go past 0, but let's take it down, right? Not saying it won't, not saying it's going to go to 14 cents. I'm not. What I'm saying is you need to have a plan in place for if it does. Your stop loss is a great plan because it would keep you from buying until it got to here, until it got all the way down and turned around again. Automating is a great optimization. Same thing happens when it's time to sell, okay? We got down here, we 5x'd up down here, our stop loss occurred, and we 5x'd up and bought the market down here. Now the market rebounds, and we see the RSI go up to here, go up to 80, right? Right around here. It's up around 80 because it's down around 40 right here, and it does one of these, and it comes up and, goes up and goes sideways or something, then we have a bull run, and it goes up to here. Well, it's the same thing. What we're going to do is we're going to say, okay, we're up here, it's time to sell. The market has come down, it's now here. Look, if the market does this and turns around and comes down, we're just going to go ahead and sell at a profit because our profit line was down here and stop the loss because, we're losing money and take our profits. Profit was down here. Here's where we're going to force to, actually take profits. Okay. However, if the market goes this direction, well, then we hit this line, and we move this line up, and we move this line up. Okay? And if the market continues to go up, then we move this line up, and we move this line up. The market continues to go up, we move this, we move this. The market continues to go up, we move this, we move this. Finally, the market doesn't quite hit our movement target here, right? And it comes back down, and it comes into this line right here, and now we take our profit. Well, it's the difference of this right here, right? This is how much money our stop loss made us. Okay? So, if we know that we have to sell, that this is our, our profit line, this is where we go into the black. Because we bought down here and we're waiting for it to recover. We're waiting for it to go above the black line. Can we activate our stop loss right here and take profits assuredly? Absolutely we can, right? Comes up to here. Hey man, it's time to start taking profits. No, it's not. It's time to start trailing stop. It's time to start trailing your stop loss. Comes up, this comes up, this comes up, this comes up. Look at how much more money we made compared to selling right here when our signal first told us to sell. Okay? The idea is that if you accept that maybe it will go up and then come down a little bit sometimes, and you'll be missing that little bit in order to take advantage of the opportunity that the automation creates for you, you'll still come out ahead. But on the times when you make more, you will make much, much more than that little itty bit that you will lose right here in between where it came up, turned around, and came back down, and you hit your stop loss, which is above your profit taking line. This opportunity is bigger. This opportunity will always be bigger on an infinite time frame. It's just a matter of how long you're playing the markets. You want to create these opportunities for yourself over the long enough time frame. On the chance that the market just goes sideways and turns back around and comes back down, well, look at, you made money above your profit line, do it again, buy back in. Comes up, do it again, buy back in. Comes up, do it again, buy back in. Comes up, comes down, buy more. Bring your profit line down. This should be ingrained into your mind as a way of thinking, right? Is this automation? The 1-2-N is if you find yourself doing something manually, automate it. And I've shown you some ways of automating, and I'm going to show you others. I'm going to show you opportunities for automation. But I want you to think hard about the role automation has in your life and can have in your trading with regards to creating these opportunities, and look back and find these opportunities where the signal would have told you to get in, because look at the signal's telling you to get in. But would a stop loss give you a better opportunity? Because this is the worst case scenario. It goes up and you have to buy at a slightly higher rate. Buy at 130. Worst case scenario. Best case scenario is you come down here and you get a better rate. Come down here and get a better rate. Better rate, better rate, better rate. All the way down the market. If you see that opportunity will still make you money because it would have worked, it wouldn't have worked here. If you had bought, it would have worked here if you had signaled to buy here after this dip. It would have kept you out until here. If you had bought here, it might have kept you from buying until this green candle occurred. Well, you could still make money, especially if you dollar cost average here and then bring it up here. All of this revolves around planning. All of this revolves around allocation. All of this revolves around diversification. And you have to do it all at the same time. You have to be master of it all. If you have a plan, this should be fearless. There should be no emotion involved. This is math. If you cannot work the numbers, don't spend the money. Don't spend the money. It's ridiculous that people would lose money in these markets. If you do, it's because you're not planning. You're not planning to sell a little bit. So let's talk about that as the final piece of this. What happens when you bought up here and you have been buying and buying and buying? Because this is the plan, and it's not making you money. And I told you, if something's not making you money, the answer is go buy something else. Quit investing in markets that are not making you money, right? Go look for markets that have better opportunities in them. Go look for charts that, have already gone down and are looking for opportunities to go up and are going up. Go look for, those opportunities, because this is not where the money is getting made right now. Until now, maybe. Or until down here, or until down here. It's got to be somewhere. Here's zero right here. The point is, let's assume that you really did come all the way down here. And man, you're heavy. You are heavy in ether. Because that's how it ended up. At the bottom of the market. And you're looking at the top and seeing the bottom and going, damn it, damn it, damn it, son of a bitch. I really screwed that one up. What do I do now? Well, you didn't. You created an opportunity for yourself. First of all, Ether is a great thing to be, trading other coins with. But more importantly, much more importantly, you are at the measured bottom here. You don't have that much farther to run. If it just keeps going down, well, buy more. Wait till it gets to 50 and buy more. And then make a plan to do the opposite, which is sell. Distribution in reverse. How much are you going to sell here? 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 Well, there's a simple answer. Simple answer is you could sell, you reach if this is your profit line and this is where you're saying, look, man, $200, that's double my money from the 111 that I bought it for, practically. Get to 220 and sell. That's what I'm happy with. We'll sell half of your load, right? And if it comes back down here, we'll buy it back. If you sold for 200, buy it back for 100. Buy twice as much for 200 for 100 if you can. Right? Because you made that money up here. Use all that money and buy it back. Make sure you have a plan in place for down here when doing so. How much do I sell up here? Well, if you sold half of it here, you could sell of the remaining portion, half up here. And of the remaining portion, half up here. And of the remaining portion, half up here. Do you ever have to sell all of it? No. You can always have more for that moon shot. Here you'd have half your original. Here you'd have a quarter. Here you'd have an eighth. Here you'd have a 16th. Here you'd have a 32nd. Here you'd have a 64th. Be selling a 64th of the original position. But you're making money the whole way up. Okay? The minute it turns around again, buy it back. That plan is valid. The minute the market turns around and comes back down and hits one of these, the plan is valid. You buy it back. If you want to allocate Ether for yourself, buy back twice as much. If you want to allocate dollars for yourself, buy back the original amount. What you're doing is you're creating that opportunity for yourself. By buying back the original amount, you're keeping the dollars. By buying back twice as much, you're buying your original Ethereum back at its original cost, plus twice as much for free. You now have free Ethereum. And that is how you use these opportunities and these are statistical. They work sometimes and you don't know when. And no amount of charting is going to tell you. Planning to take your opportunities where you know where your opportunities are. Creating this automation. Creating this opportunity through automation. If you do this enough times, if you plan constantly, if you continue to find ways to change the ever-growing amount of work that you have to do, the ever-growing number of charts that you must study on a daily basis, the ever-growing number of exchanges that you have to log into, You gotta bring that down. You gotta do something, okay? Because it needs to continue to grow the next day. The next day, it's a new one. Bring it down. There are tools that will help you. They're in the Discord. I'll show you how to use them. That will be part of our training. But what I want you to do is I want you to very carefully go look at a bunch of coins. CMC Crypto. Go look at all 20. Top 20. CMC. Go look at all the exchanges that you could have created for yourself. Go look at all the exchanges that you could create for yourself. Go look at your diversification plan. Go look at your cold wallets. Go look at your, your plans to buy into ICOs, because they do make you money. Some of them are scams. Don't know which one. Can't tell you. Look for ways to spend your money besides markets, okay? And most importantly, when doing this on an exchange, we've planned out how to make our money in these opportunities, even when these opportunities go away from us. Well, did you plan how much money you plan to lose when the exchange gets hacked? Did you plan how much of your portfolio you plan to get robbed when the exchange goes away and disappears in the night with your money? Says they're insolvent, doesn't have the bitcoins to pay you back. Hacker took them all. Happens all the time. How much of your portfolio did you plan to keep off that exchange so you can keep going? This is not the exchange's failure. This is your failure. If you did not plan to have enough money to keep going when the exchange takes all of your money, you have failed to plan. You have failed to diversify. You have failed the very important lesson of today's Mindset Monday, which is diversification. So make sure that you plan the trade and trade the plan. And that is the way of the trader. Thank you so much for joining me. I really look forward to the next lesson, where we'll be studying how to aggregate all of this information together in a meaningful way and apply automation to planning itself. Thank you very much, and have a great rest of the day. I look forward to the afternoon session with you guys.